In this video, we're going to go through the structural levels on Bitcoin. We're also going to look back into the past. We're going to see what happened around halving events and how long is it to the next halving and what could happen then. We'll also look back into something that's pretty cool, and I've not seen anybody else talk about this. There's typically been 2 capitulations per halving event. Just before the halving, we tend to see 2 capitulations, not just one. I'll explain how you can profit from this sort of behavior, as well as how you can profit from halving events. We'll also look at the geological formations of SLs and see how they capture price and magnetize price and rebound it, using Tesla as an example. Let's run the numbers. Whilst the crypto market has been booming, and we can see total crypto market cap, Bitcoin, Ethereum, Binance Coin also doing very, very well, as is MicroStrategy. This is largely because $114.56 million worth of short liquidations have hit the market. However, inside the main markets, the S&P 500, the Nasdaq, Nvidia, Apple, and Microsoft all retraced. However, Tesla hit really strong structural support and bounced up. Meanwhile, in Forex and commodities, things are all over the place. The DXY is decaying, as is the Aussie dollar, whilst the Japanese yen and the British pound is going for it, as well as the euro. This is whilst the US 10-year yield comes down, the US 2 goes up, gold is positive, and silver has been hit. You can also see the copper has come down, junk bonds, the VIX went up, and US oil went up. A thing to note for CTKS service members, total crypto market cap, Ethereum and Binance Coin, all of those upper boundary indicators have been adjusted. We're going to check the structural levels now on Tesla. It's a very interesting chart. When looking at Tesla's price going back to June, what we can see is that Tesla had been struggling. It was basically coming down. It almost turned around, but it dropped, and dropped hard. It's now restaging a bit of a rebound. But why is this the fact? When you understand the CTKS method, what you'll see is that we mark up all of price history according to international standards, level 1 and level 2. This is very important because these standards define the most statistically significant support and resistance lines available. I'll zoom in to this area so we can better understand what's happening with Tesla's price action. And don't forget, Tesla is coming up as Apple, Nvidia, and the major indices come down. Just before we look at the structural levels, we're just going to have a look at geology. Why on heck would we look at geology? When you look at geology from a geological perspective, rocks tell a story. They tell a story of formation. They tell a story of what minerals and what exists in the ground. And this, of course, is very important to mining companies. Just like price action within charts, geology looks at action of the earth within minerals. And it's a big area. It's not just mining companies that benefit from geology. If there are tectonic plate shifts, that means that there will be earthquakes. When we apply the CTKS method to a chart, it's like we're geologists. We're looking at the areas of support and resistance inside a chart. And there's not just one area of support and resistance. We can see right up here, Tesla was losing its structural support area around that 210 level, and it had a negative fresh air gap. That meant if it did come down, it would come down very quickly. However, there was a lot of structural support around the 189 to 193 mark. When you get a negative fresh air gap like this, you can have a lot of safety nets, but it doesn't mean it acts as a brick wall. It acts as a trampoline. It can go further down, and that's what we saw when it came down to 182. These areas of structural support can turn into structural resistance when the price is below it, but it takes a certain amount of time, and this chart is on a daily basis. We can see that Tesla just crunched through this level, got magnetized and flipped back up, then couldn't maintain it. The buyers stepped in around that 174 mark and pushed the price back up, and then Tesla converted this one structural resistance into structural support. Quite often, we'll see a particular chart have to come back and retest and consolidate before moving up. We can see Tesla is starting to move up, and the next structural resistance level is around this 206 area. There's a ton of structural support underneath Tesla's price at the current time. Everybody was very negative on Tesla when it sold down. We weren't, because we knew that all of this structural support, which was very strong, like a geological rock formation, would step in and save Tesla's price from falling down further. It would get gravitationally attracted to these structural support areas. The CTKS method is a lot like looking at geological formations, but it's a lot like physics as well, because these areas are magnetized. If it can't go below, it's coming back above, and when you have a lot of structural areas, they get magnetized. I'm just changing the view on Tesla towards the 1 hour view, just to explain a little bit about how these geological foundations or formations inside a chart bear out on price action. These particular lines are called Stanfield levels, or SLs. If there's a line above current price, or the price that you are looking at a specific point of time, that's structural resistance, and there down below is structural support. We can see that if a price can't get up to structural resistance, it's coming back into structural support areas. When there's a lot of negative momentum, they can just move through these structural support areas, but they act as trampolines to ping the price back, and that's what we saw. This is what you want to keep your eye open for. This retesting of structural support and making sure that the price is moving in the right direction. When we look at Tesla now, there's nothing stopping Tesla coming back and retracing a little, seeking to break out to the upside. These structural support areas are ideal dollar cost averaging areas. You should keep them in mind. Financial markets are incredibly complex systems. Getting your timing right is vitally important. That's why we have the cheat sheet. What we do is look across Forex, we look across commodities, we look across bonds and yields, also into the stock market and also crypto. We also make sure that we understand what's happening with the next FOMC meeting, the Fear and Greed Index, liquidations, and current events. It does take a little bit of time to do the cheat sheet, but it's totally worthwhile. You can see that the main markets are in a state of flux. Generally, the DXY and the dollar-yen combo move together, but at the moment they're moving opposite to each other. This could point towards the fact that the upcoming GDP numbers will disappoint. An interesting thing to note, the yields on the short end, the US 2, they're coming up currently. And the US 10-year is still decaying. It's going down. This could be to do with reverse repos. There's a very good article in the Wall Street Journal out today. The Treasury markets are losing their shock absorber. When we look at the chart of reverse repos from 2021 onwards to the current time, we can see a very clear trend. They were going up. Now they're coming down. But what does that actually mean? And what's it got to do with us and crypto and Forex and stocks? It does affect everything. Lower reverse repo balances mean that there are going to be higher volatility in the bond market. If interest rates come up, that puts pressure on the US government, which is financing its deficit. This pressure will be seen in an increase in the US 2-year and the US 10-year yield. That should also bring the DXY to the party. Dollar-yen should be coming up, where Euro-dollar and Aussie-dollar are coming down. And we can see the Aussie-dollar coming down. But what's happening? The DXY is coming down, but dollar-yen is coming up. And pound-dollar is coming up. Euro-dollar is coming up. The markets are not absorbing what's happening with yields and the reverse repos at the current time, but they will. If there's instability inside the banking system, the last time we saw that happening, crypto came up wildly. Looking back on Bitcoin's price behavior, and there's 5,200 plus days of that, we noticed that in the 2012 halving cycle, before we got to the second halving, which started the 2016 cycle, there were two capitulations in the 2012 cycle, the first and the second. When we got to 2016, there were also two capitulations, the first capitulation and the second capitulation. This is quite interesting to have two capitulations per cycle. We've only had one so far. There was a lot of variation between the two capitulations in the 2016 cycle and the 2020 cycle. We may not even get a capitulation in this particular cycle. But we must always be aware we could. If we do, that is the ultimate time to buy. If we get a capitulation that takes the price down from here, you should be diving in with everything that you've got. We're currently coming into the next halving, and we'll get into that in a minute, but I just wanted to explain when we've approached halvings. For example, the 2016 halving, we had a big spike up in price and then a sell-off. What happened in the next halving? When we came up to the next halving, we had a big spike up, but we had that capitulation with C19. And we can see that the China stock market meltdown and the Bitfinex crash was the second capitulation inside crypto, but that was a long way away from the halving. We had a much closer one to the halving in the past cycle. Technically, we could get another capitulation either side of the halving because things are looking pretty strong at the current time, but that doesn't mean they can't retrace. And if they do, buying when you've got negative price momentum inside the market sets you up for absolute incredible gains. Buying when the price is coming down is exactly what you want to do. We even have a term for it, borsog, buy on red. But typically what happens is the exact opposite. People just say, oh, the price is coming down, I got it all wrong, I have to get out of the market. And then they feel upset, guilty, and ashamed. You shouldn't feel any of those things. I know it's very natural to do so, but you're looking at a wave-based function. You always see volatility inside the market. The markets are not a straight line. Typically what happens, people get scared out of the market, and when the market's gone up for a certain period of time, they get back in only to see prices come crashing down. This is because we're all taught that the green light means go. When you're driving, you don't run a red light. You're going to get a fine for that. But if you go on the green with financial markets, you can be in a lot of trouble. You must know what you're doing. And typically what happens, you can see here, the second halving in 2016, we had this big retracement here. It may not look like much, but it is. You can see here, when we zoom in, this negative price momentum was a 30% drop in the price of Bitcoin. Of course, the alts bled 2-to-1, 3-to-1 against that. And when the halving occurred, everybody thought, oh, it's going to go to the moon. It's just going to go up and up and up and never come down. You can see price is always moving in a wave. You must be prepared for the negative price momentum because that's how you make a fortune. Do not just automatically think that things are going to come up and never come down, because if you do that, you'll get on the wrong side of the percentage. Also, you'll fall into the institutional trap. The institutions want to attract you into the market when it's green, and they want you to run like hell when it goes red. Why is that? Because they're dumping their loads, because they're going to push the price up. And you can see that's exactly what they do. Become an institution of one. When you see red action like this, just make sure that you know where the structural support areas are inside market structure. It is vital to understand the structure. Do not go with retail structure. Having studied finance and coming from a finance, actuarial and statistical background, what you will find when people just draw up recent indicative price, their particular levels are not statistically significant, which basically means they're not strong. Also, you will tend to see people just draw one or two levels. This is not the way that financial markets work. There are many levels. It's like a geological rock formation. If you do not know your levels, you will not know where price is going to come down to and rebound from. Just remember what we were talking about with Tesla's price action. We knew that there was very, very strong structural support. The probability was that it will come down and get rebounded from it. And that's exactly what has happened. But it doesn't happen overnight. Another thing, if we were looking at this particular action coming into the second halving in 2016, look how price just exploded, went a bit wobbly, then went sideways and came down. From that peak to that bottom is a 40% drawdown. This is really significant. You could almost say that Bitcoin nearly lost half its value after the halving or leading up to this peak, from this peak to that bottom there. The reason that we have structural levels on all of the charts is because we must know where structure is getting broken and where it's getting activated so we can make informed decisions. One of the biggest reasons people lose money inside any market, it can be crypto, it can be forex, it can be stocks, it doesn't matter what it is. They get attracted in when things go green and they get shaken out of the market when things go red. And you can see it's always on. It's always green and then it's red, it's green, it's red. And I just wanted to show you this. Just say that you were holding since this particular peak and you saw price starting to go up. And we'll just use this area because it's a better area, because that's where the price came down to. At this area, people would say, oh no, I've missed out. Oh, Bitcoin is going to $1 billion. I can't get in. I can never get in. And they would eventually say, okay, I'm going to buy. And then what happens? Price comes down 35% within a week. You never miss out when it comes to crypto. Crypto is so incredibly volatile. It's always doing these crazy movements, both to the upside and to the downside. Don't be concerned at all about it. What you must know is the structure. As price is going up and up and up, and it will at some stage, and probably likely after the halving, if that happens, and it probably will, just understand that there are so many retracements along the path to the top. You can never miss out, but stop being retail. A lot of people say, oh, as a retail investor, you know, you're going to do this and that. Please don't listen to people like that. They'll just wreck you. You need to be institutional in your thinking. If you run away when the price goes red, you're not going to be successful inside any financial market. Doesn't matter, crypto, stocks, commodities, forex, it is irrelevant. You will lose money, guaranteed. I'm sorry to say that. That's a really harsh reality, but you must embrace it, because if you start to get excited as the price goes red, then you can do really well. Now, why do I say that? Well, I'll prove it. You'll find this is why our community is always yelling Borsog, buy on red, because it's so profitable. Just say that you unfortunately bought here and then you fortunately bought at the bottom. You just say you had two positions, one really unfortunate position and one really good position. The really good position to this level came up nearly 60%. Now, the first position held and it didn't come, well, it came down a little bit. But let's just see this second position. If it went all the way to the top, in that case, it actually increases what? 146%. This is why you must buy as the price is going down. But in order to do it correctly, please mark up your charts with the level 1 and level 2 standard certification of the CTKS method. Alternately, you can just pop on the indicator from the monthly service to save your time. But the key is, whatever you do, make sure that you're buying on red. You should be dollar cost averaging in at these times. When is the halving occurring? It's occurring in about 58 days, or the 25th of April 2024. In the third halving that occurred in 2020, we can see that we actually had a sell down coming into the halving of around 19%. It's about 20% if you take the tip of that tail the day before the halving. A lot of people are saying only up, Bitcoin can never come down. Please don't listen to those people. It's wave function stuff. Price is just moving in a wave. It's always coming down and it's always going up. The key to success in any financial market is have a down strategy, a neutral strategy, and an up strategy. What could that look like? Coming into the halving, having a down strategy, buying 20 to 40% down, having a neutral strategy. And of course, all of these strategies rely on you understanding the structure of what you're trading and investing in. But having a down strategy is a really good idea at all times inside crypto. Crypto is very volatile, but it's incredibly forgiving as well. Right now, the halving is nearly 2 months away, so it's got quite a bit of time to play out. We could see an upsurge. But upsurge to where? Of course, structural levels. If we see a downward momentum, where would that be to? Again, structural levels. And also have your up strategy, your neutral strategy, or your boring strategy, and your down strategy decided ahead of time. Across the years, I've had many people come to me and said, "Oh, Ken, you're really right. You need an up strategy, a neutral strategy, and a down strategy." They often say, "I thought I had 3 strategies, but in truth, I only had 1." Let's pop on the structural levels for Bitcoin, covering in excess of 5,200 days by the indicator. What we can see is we actually got a bounce up. Very interesting that it retraced and filled the orders at these structural support areas and that it just bounced like a Super Bowl. There were so many short liquidations that it just went up and up and up. The next area of structural resistance is 55,600. At this 53,300 mark to 53,500, we've got a degree of structural support. We may see Bitcoin coming back and reclaiming and retesting these areas before shooting up for a positive case. If it goes negative, we're going to get weaker price action in here, looking something like this, to come down again and retest that around 51,000 mark. Please let me know in the comments, where do you think Bitcoin's headed to next? And do you have a 3-dimensional strategy? Or are you just saying, no, I've got one, but I kind of considered the other 2, but I then ignored them? Keeping in mind Rule 654 that prices move SL to SL. If you know where the SLs are, you're not so concerned about price movement. Typically, we don't know where the Stanfield levels are, how strong they are, how clustered they are. You can get the structural levels on all of these particular indicators, the Tier 1 charts, the Tier 2 and the Tier 3. We've just looked at the structural levels from the service for Bitcoin as well as Tesla, but looking throughout all of them is really important. You need to do that to fill in your cheat sheet correctly. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. And please let me know, are there any specific topics that you would like us to cover for you? And if you like the content, please destroy gently that like button and don't forget to subscribe.